In this video, we're finally going to be talking about why Tesla should be worth $4,500 by 2025. This is part 3 of 3. If you haven't seen parts 1 and 2 yet, I recommend that you watch those first. I'll put a link in the description below. In parts 1 and 2, we talk about why Tesla should be able to produce 4.4 million cars and reach 40% gross margins in 2025. And in this video, it's going to be very numbers oriented. So if you're just listening right now, I recommend that you wait until you can look at the screen before watching any further. All right, so let's talk about operating expenses. Here's a graph of what the operating expenses have been for the past 5 years. From 2017 to 2021, operating expenses has gone from 3.8 billion to 6.6 billion. At first glance, this may sound like a large increase, but this is actually a very small increase. If you consider that in 2017, Tesla's revenue was about 11.8 billion versus in 2021, revenue was 53.8 billion. So their operating expenses went up about 75%, while revenue went up almost 500%. Also, during this time, Tesla built 2 new factories, added about 25,000 superchargers, and hired an additional 80,000 employees. It's actually quite amazing how they're able to keep expenses so low during this time. So if OPEX went up 75% over the last 5 years, is it reasonable to say that over the next 5 years, OPEX will go up another 75%? I think yes, but to be a little bit more conservative, let's say instead of 5 years, we use 4 years, and instead of going up 75%, OPEX will go up 100% during that time. So it will go from 6.6 billion today to 13.2 billion in 2025. Moving on to the next graph, using my numbers from part 1 and 2, this is what I think operating income should look like, represented by the purple line. Operating income is just gross profit minus operating expenses. So it's just the pink bar minus the blue bar. So in 2025, we should have about 83.7 billion in operating income. Operating income is not the same as profit. We still have to take out interest expense and taxes, but there are a lot of ways that Tesla could essentially cover their taxes and interest because there are other ways Tesla makes money besides selling cars. The information here just represents the automotive business, but Tesla also has Tesla Energy, Tesla Insurance, Tesla Superchargers. They could license out their supercharging network to other manufacturers. They could license out their Tesla Autopilot and full self-driving software to other manufacturers. And they could also sell regulatory tax credits to other manufacturers. For simplicity's sake, I like to just say that all those other business lines will cover tax and interest and treat automotive operating income as if it's overall net income. I hope that makes sense. That leaves us with $83.7 billion of net income. Now, to get to a stock price, I like to just use a simple PE ratio to value a stock. To figure out a reasonable PE, we have to figure out the growth rate for Tesla. A high growth rate would give Tesla a higher PE and therefore a higher stock price. A low growth rate would give Tesla a lower PE and therefore a lower stock price. To come up with the growth rate for 2021, for example, I would take the 2022 operating income and compare them to 2021. In 2021, they earned $7.2 billion in operating income, and for 2022, I have them earning $19 billion. 7.2 to 19 billion is 164% growth. So I'm estimating that they will grow their earnings from 2021 to 2022 by 164%. Here's the rest of my estimations from 2021 to 2025. Growth rate is a forward-looking metric, so to get the 2025 growth rate, I need to estimate operating income for 2026. I decided to just carry out similar assumptions through 2026 with sales going up to 5.8 million units, average sale price going up to 60,000, and margins going to 40% average for the year. This is all reasonable considering that factories 5 and 6 should be producing at scale at this point, and full self-driving should be even more developed. Given those assumptions, I have Tesla growing their earnings by 47% in 2025. So with a 47% growth in earnings, the question is, what is a fair PE ratio to assign to Tesla in 2025? In order to do this, we assign what's called a PEG ratio or a PEG ratio. If you look up what a good PEG ratio is in investing literature, it would say that a 1 PEG ratio would be considered very good. That means if Tesla is growing their earnings at 47%, then a PE ratio of 47 would be considered pretty good value. However, a fair PEG ratio is going to be determined by investor sentiment and interest rates at the time. And it's really hard, if not impossible, to know what investor sentiment and interest rates will be in 2025. So with a net income of 83.75 billion at a 47% growth rate, here are some example PEG ratios and the valuations associated with those PEG ratios. At a 1 PEG ratio, Tesla will be trading at around $3,400 in 2025. At 1.33 PEG, the stock would be around $4,500. And at a 1.66 PEG, the stock would be trading at about $5,700. Given the quality of the company, I think that a PEG of 1 would be considered too low. At a 1.66 PEG, I would consider that a full valuation, but I'd be surprised if it traded that high. At 1.33 PEG, I think that would make a lot of sense for Tesla. It will put Tesla as probably the most valuable company in the world. Companies like Apple, Google, Microsoft, and Amazon would probably be similar in market cap, but I don't think they're going to be higher than Tesla. So it would be difficult for Tesla to be trading at above 1.5 PEG just because of the sheer size of the market cap of the company. In order for the company to double again, it would have to reach a $10 trillion market cap, and it would just be hard to imagine for most investors to believe that. Tesla also has historically been greatly misunderstood by the market and will continue to be misunderstood in the future, so I don't really imagine that it'll get a full valuation above 1.5 PEG. Just for funsies, I also mapped the corresponding growth rates with the estimated operating income per year and assigned sample PEG ratios per year. The results come out in market cap, not stock price. I'm not going to go over these. You can just pause the video if you want to look at them. I don't know if they're super helpful. I think it's probably better and simpler just to have a price target for a certain year and then discount that back with a discount rate to get the present value. For example, if my price target for Tesla is $4,500 in 2025, how much am I willing to pay for that stock today? I can't pay $4,500 because I could have invested that money somewhere else in order to make a return. So I pick a discount rate to represent an opportunity cost. I'll pick 9%, which is kind of the average return over time for the S&P 500. I just plug these numbers into a present value calculator. $4,500 for future value, number of periods is 4 because 2025 is about 4 years from now, even though we're already in April of 2022. So interest rate is the same as discount rate, which we'll use 9%. Press calculate and we get a present value of 3,187. So this is saying that if I'm right and Tesla is worth $4,500 in 2025, then as long as I pay less than $3,187, I should beat the S&P historical return. Tesla today is trading at around $1,000, which is a huge margin of safety. Even if I'm way off and super inaccurate in my prediction, I mean, how wrong can I be? Anyways, I hope this goes without saying that this is all opinion and highly speculative. I took a lot of shortcuts, especially because I assumed that Tesla's automotive operating income is going to be the same as their overall net income, which means that Tesla's other business lines are going to have to do a lot better than they are today in order to cover their taxes and interest expense. But hopefully I was a little bit conservative in other areas and everything balances out. Let me know if you like this type of video by clicking on the like button, share with your friends. This type of video takes a really long time, but if I know that the people of YouTube like this type of video, then I'll do more for the other stocks that I own. Thanks for watching. See you in the next video.
Chicken. Hi, hi. Turn. See that turn.